Stop. Just stop. Everything you're being told about this move right now is a distraction. A magician's flourish with the right hand so you don't see the left hand setting the trap, the collapse on your screen, the breathless headlines, the analysts tripping over each other to name the cause. It's all noise engineered for your nervous system. This was not about interest rate fears. It was not about a surprise election poll. It was not about a hedge fund blowing up. Those are scripts written in real time to explain a phenomenon that operates on a different layer of reality entirely. What you witnessed was a maxichio's liquidity seizure, a temporary systemic cramp in the plumbing that moves money and collateral between the biggest players. When that plumbing freezes, even for minutes, everything that depends on its flow, every leveraged position, every algorithmic strategy, every ETF that promises instant liquidity, goes into a violent, self-reinforcing spasm. This is not chaos. This is physics. And by the time we're done, you'll be able to see the equations, not the panic. Let's begin at the true point of fracture, which happened not today, but 96 hours ago. In the foreign exchange swap market, a specific arcane spread, the cross-currency basis swap for funding US dollars using euro-denominated collateral, experienced a persistent grinding widening. It didn't make the news. It never does. But to the treasury desks of global banks and the risk committees of commodity trading advisors, this is a flashing red light. It means the cost of accessing the US dollar liquidity needed to fund and margin a global portfolio of assets just got more expensive. Not for everyone, but for the marginal leveraged player, the one providing the crucial liquidity at the edge of the market, it moved from profitable to uneconomic. So what does a rational entity do? It doesn't scream. It doesn't issue a press release. It quietly dials down its risk exposure. It pulls its quotes. It reduces the size it's willing to trade. It doesn't sell a thing. It simply ceases to be a buyer. This is the silent first step, the withdrawal of the deepest, most patient capital. The market doesn't crash at this point. It just becomes hollow. It becomes a beautiful, ornate facade with no supporting walls. It can stand perfectly still in calm air, but the next gust will bring it down. The gust is always insignificant. It must be, because the point is to prove the fragility was structural, not informational. Today's gust was a misinterpreted comment from a mid-level official during a Q&A session at a minor economic forum. A sentence fragment taken out of context, tweeted by a semi-anonymous algo news scraper, and within 47 seconds, it was being processed by thousands of trading systems as a potential macro catalyst. In a healthy market, this is a blip. In our hollowed-out market, it's a wrecking ball. The first to react are not humans. They are market on close and volume-weighted average price algorithms used by passive funds and institutional rebalancers. Their mandate is simple: achieve a certain price for a large basket of trades by the end of the session. When they detect unusual price movement against their required direction, they are programmed to, aggressively front-run their own future orders. They begin buying or selling now to avoid a worse price later. This creates an immediate, powerful surge in volume and momentum. It's the shove that starts the avalanche. Now we enter the core of the cascade, the volatility feedback loop. This is where the market begins to eat itself. This initial surge in volume and price movement causes a sharp spike in short-term realized volatility. This spike is picked up by a different class of system, the volatility targeting funds and the risk parity strategies. Their entire existence is governed by maintaining a constant level of portfolio volatility. If asset volatility rises, they are forced to sell assets to bring their total risk back down to their target. They are not selling because they think the price is going lower. They are selling because a number on their dashboard, a calculated measure of turbulence, has moved outside a defined band. This selling is enormous, mechanical, and utterly without malice. It pushes prices down further. This, in turn, causes volatility to recalculate, and it is now even higher. This triggers the next layer: CTAs, commodity trading advisors, using trend-following models. Their systems, which were likely already holding a modest long position based on the prior trend, now see that trend break. Their models generate a sell signal, not all at once, but in a wave as the price crosses below various moving averages, the 20-day, the 50-day, the 100-day. Each breach triggers another batch of automated selling. This is the domino effect. Each domino is a line of code, a rule in a spreadsheet, a parameter in a risk model. The selling begets more selling through this mechanical chain. This entire process can unfold in 15 minutes. It feels like panic. It is, in fact, the exact opposite. It is the cold, flawless execution of pre-programmed logic. The panic narrative is applied afterwards by humans who cannot comprehend such scale and speed without attributing emotion to it. Now we must split the world in two. On one side, the paper market, the world of futures, ETFs, options, and leveraged derivatives. This is where the cascade is happening. This market is purely financial, a web of promises and bets. Its price is set at the margin by the most recent trade, and it is hypersensitive to these liquidity and volatility shocks. On the other side is the physical or cash market, the actual buying and selling of the underlying asset for immediate use, or the over-the-counter, OTC, forward market between end users. Watch what happens here. In the paper market, the bid-ask spread blows out and the price tanks. In the physical market, the bid-ask spread also blows out, but often in the opposite direction. Sellers of the physical asset vanish. They see the paper crash and say, "No, I will not give you my real barrel of oil, my ounce of metal, my bond certificate for a price set by a derivative seizure." Instead, the offers are pulled. The price to buy the physical thing actually rises relative to the crashing paper future. This is called a dislocation. The basis gap explodes. If you're an industrial consumer who needs this asset next month, your cost just went up, not down. This is the ultimate tell. It reveals that the panic is confined to the financial engineering layer. The real economy's demand for the actual thing is unmoved, or is now facing a supply constraint because the usual arbitrageurs who would buy the cheap paper and sell the expensive physical to close the gap are paralyzed because their funding liquidity, remember that FX swap spread, just dried up. This dislocation is your single most important data point. It screams that the move is technical, not fundamental. History doesn't give us a precise map, but it gives us the same fingerprints on a different weapon. Look at the flash crash of 2010. A large sell order in a thin market, E-mini S&P futures, triggered a volatility cascade that was massively amplified by predatory high-frequency trading algorithms racing to liquidity. Look at the taper tantrum of 2013. The mere suggestion of the Fed slowing its bond purchases caused a repricing of funding liquidity globally, leading to a violent correlated sell-off in emerging markets. Look at the Volmageddon of February 2018. The direct implosion of short volatility ETFs, which were mechanically forced to sell S&P futures as volatility rose, creating a perfect feedback loop. Each event was unique in its catalyst, but identical in its structure. A hidden vulnerability in market plumbing, liquidity, leverage, or derivative hedging, is exposed by a shock, triggering a rules-based, self-reinforcing cascade that far exceeds the informational value of the initial shock. Today's event is a member of this family. It is not an outlier. It is a recurring symptom of a system built for efficiency, not for resilience. These events cluster around quarterly cycles, because that's when balance sheets are constrained. Leverage is reassessed and derivative positions are rolled, moments of inherent structural vulnerability. We now arrive at the most crucial phase, the narrative capture. The mechanical selling is largely exhausted. The volatility has peaked and is starting to decay. The market is bruised, battered, and trading in a ragged, low-volume range. This is the moment of maximum danger for the individual investor. This is when the psychological operation begins. The entire financial media complex, which has been chasing the move like reporters chasing a fire truck, now must explain why it happened. They cannot say a cross-currency basis swap widened, triggering a withdrawal of dealer liquidity, which exacerbated a volatility feedback loop during a quarterly rebalance. That doesn't sell ads. It doesn't generate clicks. So they and an army of social media influencers solidify around a simple, emotionally potent story. The rally is over. The data confirms a recession. Smart money is fleeing. This story is repeated, amplified, and dressed up with charts and quotes from experts who have a positional vested interest in the new narrative. Its purpose is to legitimize the price move and to induce delayed emotional capitulation. They need the long-term holder, who sat stone-faced through the mechanical dump, to now look at their portfolio, read the news, feel the fear in the air, and finally crack, to sell their core position at the lows. This emotional distressed selling provides the final necessary liquidity to true value buyers, the ones with strong balance sheets and no leverage issues, who can now step in and mop up assets at a discount. The emotional seller is the ultimate source of fuel for the market's reset. They are the weak hands being flushed out. The entire second act of the drama is designed to create them. So let's synthesize. The sequence is clear, and it is procedural. Step 1. A preconditioning stress in a related obscure funding market silently reduces the system's liquidity buffer. Step 2. Key market-making entities withdraw from providing depth, creating a brittle, thin trading environment. Step 3. A minor random catalyst triggers initial algorithmic rebalancing flows. Step 4. This movement spikes volatility, activating mandatory selling from volatility-sensitive and trend-following funds, creating a self-fueling cascade. Step 5. The paper market collapses while the physical dollar-to-cash market dislocates, revealing the technical nature of the event. Step 6. The exhausted mechanical move is followed by a powerful narrative campaign designed to harvest emotional selling from long-term holders, providing the final liquidity for a stable bottom. Your power lies in refusing to participate in the psychological theater. Your job is not to predict the bottom, but to diagnose the state of the system. You become a forensic analyst of market structure. You ignore the shouting and you watch the dials. You watch the ICE BOAML Move Index for bond volatility. You watch the CBOE Skew Index for tail risk perceptions in equities. You watch the gold forward offered rate, GOFO, or the lease rates for metals. You watch the FRA OIS spread in rates and the TED spread for interbank stress. You monitor the open interest in key futures contracts. Is it collapsing, leverage fleeing, or holding steady? Conviction remaining. These are your vital signs. When the headlines are at their most apocalyptic, you look at these metrics. If they are stabilizing or improving, the structural seizure is passing. The patient is recovering from the heart attack, even though it's still lying in the ICU. If they continue to deteriorate, then the systemic stress is ongoing and the risk of another leg down remains. The final, most important realization is this: the market is not a voting machine in the short term. It is a complex hydraulic system. Price is the pressure reading on one gauge. Liquidity is the flow in the pipes. Leverage is the volume of fluid in the system. Volatility is the shutter in the pipes. What you witnessed today was a pressure spike caused by a valve being closed, followed by a series of automatic pressure release valves triggering in sequence. It was noisy, it was scary, it caused damage, but it was a controlled release within the engineering of the system itself. The system did not break. It performed exactly as designed, albeit in a way that is catastrophic for those who mistook the pressure gauge for a measure of true value. Your edge is no longer in finding the next hot stock or predicting Fed policy. Your edge is in understanding the hydraulics, in knowing which valves are where and what happens when they shut. When you possess that knowledge, the fear transforms into focus. The chaos resolves into a schematic. You are no longer a passenger on a ship in a storm, terrified of the waves. You are in the engine room, reading the pressure gauges, and you know the storm is just forcing a change in the boiler's output. The ship keeps going. Stay in the engine room.